You ever get that feeling you're watching two different movies at the same time? On one screen, you've got the stock market just roaring ahead, hitting record highs, celebrating what's to come. But then you flip the channel, and the economic news is, well, let's just say it's a lot less exciting. That's the puzzle we're going to unpack in this explainer, this great disconnect between how the market feels and what the data says. All right, let's get into it. So here's how we're going to break it down. First, we'll look at the super bullish story the market is telling itself. Then we're going to hold that up against the cold, hard economic facts. That's the great disconnect. From there, we'll zoom out and see how the whole world seems to be pulling apart. We'll dive into the risky bets that this kind of environment creates. And finally, we'll piece it all together to look at the fragile road ahead. Okay, first up, the market's paradox. Because seriously, if you just glance at the headlines, everything looks awesome, right? The story is simple and clear. Markets are booming, and the good times are here to stay. And what's at the heart of all this optimism? It really boils down to one single powerful belief, that the Federal Reserve is going to start cutting interest rates any day now. That's the story, and it's so compelling that it's getting investors to just completely ignore some pretty major warning signs flashing in the background. And that brings us right to the main event here, the great disconnect. Because the second you turn away from the headlines and you start looking at the actual numbers, a completely different and way more cautious story starts to take shape. And wow, this is where you can really see the split. In one corner, you've got the market's narrative, right? It's all about Fed cuts and the AI boom. But in the other corner, you have reality. US inflation is still stubbornly high. And the job market, yeah, it's starting to look a little shaky. It's like they're talking about two totally different planets. The contradiction gets even weirder, though. We're seeing market valuations that are, to put it mildly, expensive. But, and this is the wild part, at the exact same time, the data shows that the momentum, the actual engine driving the market, is slowing down. A lot. So prices are going up while the power is going down. How does that work? And if you want one single number that perfectly captures this whole situation, this is it. The VIX, the market's fear gauge, it's sitting in the 8th percentile. To put that in plain English, it's basically asleep. There is no fear out there. And that is a textbook sign of extreme complacency. It means the market is dangerously underpricing the chance that something, anything, could go wrong. But hey, this isn't just a US story. Not at all. When we pull the lens back and look at the whole planet, we see the entire global economy is fracturing, literally pulling apart at the seams, with different parts moving at totally different speeds. And the contrast is just stark. You've got India just booming, with GDP growth close to 8%. Then there's the US, which seems resilient on the surface. But compare that to China, which is fighting deflation, and the euro area, which is pretty much at a standstill. This isn't one global economy. It feels more like four separate stories all happening at once. Let's run through them. First, you've got India, the clear standout. It is structurally accelerating, just powered by incredible domestic demand. It's a real global growth leader right now, leaving everyone else in the dust. Then there's the US. It looks resilient, sure, but as we've seen, it's a fragile kind of strength. It's battling inflation on one side and a cooling job market on the other, which makes for a really complex picture. Meanwhile, China is stuck dealing with a really nasty combination of deflation, that's falling prices, and a massive crisis in its property sector. And that weakness is a huge drag on the entire global economy. And finally, we have the euro area, which is actively decelerating. With GDP growth barely above zero and consumer confidence dropping, it's an economy that is really struggling to get out of first gear. So what happens when you mix this feeling of total market complacency with a global economy that's splintering into pieces? Well, you get a recipe for something really risky, what we call crowded trades. So what's a crowded trade? Think of it like this. Everyone has piled onto one side of a tiny boat, totally convinced it's the only place to be. It feels safe for a while, but it only takes one little wave, one sudden change in the wind, for everyone to try and jump off at the exact same time. And that's when the boat flips. It's a stampede for the exits, and it gets ugly fast. For a perfect example, just look at the euro right now. You've got speculative traders who are all in, overwhelmingly bullish. We're talking 98th percentile. But then you look at the commercial hedgers, the folks who actually use the currency for business, often called the smart money, and they're on the complete opposite side, extremely bearish. A split that huge is a classic warning siren that a trade has gotten way, way too crowded. And this isn't just happening in currencies. We're seeing this exact same pattern pop up all over the place. Gold? Check. Copper? Check. European stocks, even high-yield bonds? Check, check. They all had these fantastic runs, but now their momentum is just fizzling out. It has all the signs of a rally that's just running on fumes, and that makes them all incredibly vulnerable to a sharp move down. So, where does all this leave us? We've got the disconnect, the global fragmentation, and these crowded, risky trades. When you put it all together, you start to see a very, very fragile path forward. A path where just one little trip up could send shockwaves through this entire complacent system. And you can literally trace how the dominoes could fall. It could all start with a shock to the US 10-year Treasury yield. That's basically the bedrock of the entire global financial system. Well, a shock there doesn't just stay put. Bam! It ripples out to global credit markets. Bam! That in turn hits emerging market stocks. And bam! That finally smacks into currencies all around the world. It's a powerful reminder that in today's world, no market is an island. So we're left with this one big question. In a market where the fear gauge is asleep and everyone is crowded into the same optimistic trades, the biggest risk isn't the one people are talking about. It's the one everyone has collectively decided to ignore. This great disconnect between perception and reality, it can't last forever. Something has to give. The only question is, what's going to be the catalyst that finally forces them to collide?